Hi, I'm PNC Joe, and I delve into the intricacies of commercial insurance. Today, I want to talk about contingent business interruption, a critical issue that affects many small business owners. This problem arises when an unforeseen event halts operations at a supplier's or partner's facility, leaving your business in limbo. Navigating the complexities of these interruptions involves understanding supply chain vulnerabilities and the potential financial impact on your enterprise. Keep watching because in this video we will discuss these important topics. What is contingent business interruption insurance? How is it different from standard business interruption insurance? What events typically trigger CBI coverage? What are common included coverages? How to determine the scope of coverage for indirect suppliers? How to calculate the financial impact of a CBI, understanding policy limits and sublimits. What is the waiting period before coverage begins, and a bonus topic at the end. Let's go through these points one at a time. Contingent business interruption, CBI insurance, is a type of coverage that helps businesses when something goes wrong at another business they rely on. For example, if you have a toy store and the factory that makes your toys has to shut down because of a fire, CBI insurance can help you cover the loss of income you might face because you can't sell toys. It's about protecting your business from problems that happen to your suppliers or customers, not directly to you. Standard business interruption insurance helps when something happens directly to your business, like a flood in your store. Contingent business interruption insurance, on the other hand, is for when something happens to someone else's business that you depend on. Imagine if your favorite bakery couldn't open because the flour supplier had a problem. The bakery would use CBI insurance to cover their losses because the issue wasn't with them directly, but with their supplier. CBI coverage is usually triggered by events that prevent your suppliers or customers from operating. Common events include natural disasters like hurricanes or earthquakes, fires, or even political unrest. For example, if a tsunami damages a factory that makes car parts, a car manufacturer might need CBI coverage because they can't get the parts they need to build cars. CBI insurance covers several important things. 1. Loss of income if your supplier can't deliver goods due to a problem. 2. Loss of income if your main customer can't buy your goods because of their problem. 3. Extra expenses you might have to pay to fix issues quickly, like finding a new supplier. 4. Losses from damage at a third-party location that affects your business. For example, if a storm damages a warehouse storing your products, CBI might cover your losses. Determining the scope of coverage for indirect suppliers can be tricky. Indirect suppliers are businesses that supply your suppliers. Imagine if you own a chocolate shop and your supplier gets cocoa from a farm. If a problem occurs at the farm, it might affect your supplier and, in turn, your shop. CBI coverage can extend to these indirect suppliers, but you need to clearly define this in your insurance policy. It's like making sure your umbrella is big enough to cover not just you, but also your backpack. Calculating the financial impact of a CBI involves figuring out how much money your business would lose if a supplier or customer can't operate. Suppose you have a coffee shop and your coffee bean supplier can't deliver beans for a month. You need to calculate how much profit you would miss out on during that time. This includes thinking about how many cups of coffee you usually sell, the price of each cup, and any other costs you save or incur. Policy limits are the maximum amount your insurance will pay for a loss. Sublimits are smaller limits for specific parts of a policy. For instance, your CBI policy might cover up to $500,000 for any incident, but only $100,000 for losses related to indirect suppliers. It's important to understand these limits so you know how much protection you have. Think of it like your parents giving you a budget for shopping, but with specific amounts set aside for clothes, books, and toys. The waiting period is the time after a loss occurs, but before the insurance starts paying. It's like a delay before you get help. For CBI insurance, the waiting period might be 48 hours to several days. During this time, you need to cover your own losses. Knowing the waiting period is important so you can plan your finances. It's similar to waiting for a package to arrive after ordering it online. To assess exposure to CBI risks, businesses should look at their supply chain and identify critical suppliers and customers. A toy store should consider who makes their toys, delivers them, and who buys them. By pinpointing these key players, a business can understand where they might be vulnerable. It's like knowing which parts of a sandcastle need extra protection from the waves. When filing a CBI claim, you need to provide documents that show the loss and its impact on your business. This might include contracts with suppliers or customers, sales records, and proof of the event causing the interruption. Think of it like showing your homework to prove you did it when you ask for extra time from your teacher. Having the right documents helps the insurance company understand and process your claim faster. Understanding contingent business interruption insurance can be a game changer for safeguarding your business against unexpected disruptions. By equipping yourself with the knowledge shared today, you'll be better prepared to handle supply chain surprises and keep your business running smoothly. Remember, preparation and clear communication with your insurance provider are key to effective coverage. If you have any questions or ideas for future videos, please let me know in the comments below.